All right, welcome. Today, we're diving into something that sounds super intimidating, derivatives. But what if I told you the secret to understanding these massive, billion-dollar financial tools isn't locked away in some crazy formula? What if it's actually hiding inside something as simple as a coin toss? Well, that's exactly what we're going to decode together.
And yeah, that quote really gets to the heart of it, doesn't it? For most of us, derivatives, and especially options, they feel like this complicated black box, something only Wall Street insiders could ever really understand. But the source material for this explainer argues that they're built on an idea that's actually incredibly simple, almost intuitive. So our goal today is to find that simple idea and make it totally clear.
So, here's our game plan. First, we'll ask, are derivatives really that complex? Then we'll get to the core idea, the power of having a choice. We'll use a simple coin toss to see how you put a price on that choice. Then we'll bridge that gap from the coin toss to the real stock market. And finally, we'll talk about why getting these basics right is so incredibly important.
Okay, section 1. First things first, let's just cut through all the jargon. What are we really talking about when we say derivatives?
You know, the financial world is just full of these crazy-sounding instruments. You hear about forwards, futures, swaps, and of course, options. Now, things like forwards and futures, they kind of lock you in. You're committed to a transaction down the road. But we're going to zero in on options because they are totally different. Our source text calls them the backbone of modern finance for one big reason. They introduce this unique, powerful element of choice. And understanding that one thing, that choice, well, that's the key to everything.
And here's a key insight from our source material. All that complexity, it's mostly a distraction. The real trick, the good solution, is to ignore the noise and find the most basic, fundamental idea at the very core of it all. Because once you see that one simple thing, everything else just kind of snaps into focus.
All right, which brings us right to that core concept. It really all boils down to a single word, a single idea that separates an option from just another rigid, boring contract.
So what is an option? At its heart, it's just a choice. That's it. It's the ability to see how things play out and then decide if you want to act. I mean, think about how powerful that is. It's like paying a small fee to reserve the right to see the future before you have to commit your money. It's basically a powerful form of financial insurance.
And this contrast it's everything. Most financial contracts are super rigid. You are locked in. You have to buy that stock. You must sell that barrel of oil, no matter what. But an option, it gives you freedom. It gives you an escape hatch. If the market turns against you and the deal looks bad, you can just walk away. All you lose is that small fee you paid upfront for the choice itself.
Okay, so if an option is a choice, how much is that choice actually worth? How do you put a price on it? Well, to figure that out, we're going to use the simplest model of uncertainty that exists, a good old-fashioned coin toss. So, if you want to figure out the fair price for any bet, whether it's on a coin toss or a stock price, the logic is always the same. There are just 3 steps. Step 1, what are all the things that could possibly happen? The outcomes. Step 2, what are the chances of each of those things happening? The probabilities. And step 3, based on that, what's a fair payout? This simple little process, this is the engine behind all financial valuation.
So look, here is the most crucial point. Forget all the complicated math you've ever heard about for a second. It all, and I mean all of it, boils down to just these 2 ideas, probabilities and payoffs. If you can get a handle on the possible payoffs and their probabilities, you can understand and value pretty much any option in the world. Okay, now for the big aha moment. This is where we connect our super simple coin toss game directly to the trading floors of Wall Street. This is where it all comes together.
Just think about it for a second. What is a stock price actually doing all day? It's going up or it's going down, an uptick or a downtick. Well, our source material points out that for over 100 years, mathematicians have modeled this as a random process, which is a lot like a coin randomly generating heads or tails. An uptick is like a head, and the downtick is like a tail. It's the same fundamental idea. And this chart, this illustrates so brilliantly what happens over time. After, say, 4 coin tosses, or you could think of it as 4 days in the stock market, you don't just get one single result. You get this whole spread of possible outcomes. And you can see it's way more likely that you'll end up somewhere in the middle, with a mix of heads and tails, than at one of the crazy extremes. This distribution, this is exactly what a stock's future price looks like, a whole range of possibilities, and each one has a different probability.
And that's the absolute core insight right there. Pricing a stock option isn't some kind of black magic. The traders are asking the exact same questions we just did for our coin toss. What is the probability that the stock will hit a certain price, and what's the payoff if it does? The logic is identical, it's just the scale that's different.
Okay, so let's bring this back from theory to the real world for a minute. Because understanding these basics, it's not just some fun academic exercise. We're talking about managing billions and billions of dollars of risk.
Wow, just listen to this quote from our source. $1 billion had disappeared overnight. Money always returns to its true owners. I mean, that is just a chilling description of the aftermath of a massive trading disaster. You know, the famous blow-ups at places like Barings Bank or long-term capital management. They weren't just a string of bad luck. They were the direct result of people losing sight of these simple fundamentals.
Because these disasters, they don't happen because derivatives are magic or impossibly complex. They happen because people get lost in their own complicated models and they forget to ask those simple foundational questions we've been talking about. What are my real probabilities? What are my actual potential payoffs? A solid grasp of the basics we've covered today, that is the ultimate defense against financial catastrophe.
And that really leaves us with one last big thought. If the basics are this simple, probabilities and payoffs, then why is avoiding disaster so incredibly hard? I mean, of course, a real stock isn't a perfect 50-50 coin. There are other factors, like volatility and interest rates that complicate the model. That's what leads to famous formulas like the Black-Scholes model. But the foundational principle we talked about, that never changes. It turns out the math is actually the easy part. The real challenge? It's applying those simple rules, consistently, day in and day out, in a market that's driven by human emotions like fear and greed. That is the billion-dollar question.